morning, everyone. Again, I want to thank you for joining our webinar this morning. We have an economic outlook on housing and what's going on with everything. There's a lot, as you all know. I do want to let you guys know that if you have any questions, please put them into that Q&A box at the bottom of your screen. We'll probably get to Q&A at the end of everything, so please listen through, put any questions in there, and then I'll come back on towards the end of Scott's presentation to go over all of those questions that you may have. And but first I'm going to introduce John with Bank of the West, and he's going to get us kicked off. And we also want to thank Bank of the West as one of our corporate sponsors, and for bringing Scott to us. He's got some great information, and we are looking forward to hearing what he has to say, and sounds like it's all positive. So thank you so much, and take it away, John.
All right. Hey, good morning, everyone. Thank you so much for joining. I am John Necker. I'm the area sales manager for Bank of the West in the SCORE footprint, and definitely a proud SCORE member affiliate. Bank of the West is very committed to SCORE, and we actually have the affiliate chairman, Jonathan Wyatt, serving this year. So first off, I want to thank you guys for joining. For you, your customers come to you for everything. This information will better help you advise your customers and understand where we are heading. And taking the time to update yourself on where the economy is going in Silicon Valley, put yourself a step ahead of the realtors that aren't taking the time to do that. So thank you very much. Can you get the next slide on there, Emma? Can we get my PowerPoint up there? And can you go to the next slide? Okay. First off, Bank of the West is owned by BNP Paribas. And as such, can you back up one? There we go. As such, we've taken a very strong position on the environment. And we're based in Paris, and with the Paris Accord, Bank of the West has taken the position that we will not invest our funds in any non-green or dirty business. And this hasn't come without pain, but it's been very worth it for us, as we now have businesses and consumers gravitating to us because they want to do the right thing, and they're concerned with global warming, and they appreciate our position, which has been somewhat painful but starting to grow. And we're banking companies now like Patagonia, Sierra Club, and stuff like that that really care about it. So please note that any monies in any business you do with us will not be invested in any non-green thing, and it's been fantastic for us. Emma, next slide. We are a portfolio lender. We lend our own money, we service our own loans, and we have some very strong niches. We're probably the best kept secret out there in the mortgage business, and we want to make sure that you guys are aware of it. Just going to highlight a couple of our niches real quick. We do 80-10-10 financing, so 10% down to 2.5 million. And a lot of people with stock, Google, Facebook people, they make a lot of money on their stock. They don't want to put a lot of money down, and this allows them to hold on to their stock and be able to put less money down when they buy it. Next off, as you know, everybody's having to pay more for a house than they want to. And we have guidelines that allow us 60 debt to income ratio. A qualified mortgage stops at 43. So we're able to help your customer qualify for more house. And I would just add that folks that are cash rich and income short, we can do asset dissipation very aggressively to be able to get more income and help them. So there's some of our niches on the board. We also do equity lines. We have a lot of people realtors sending their customers to our branches to help them with equity lines because they know how good we are at it. Okay, next one. How do you find us, and who are our mortgage bankers? Well, first off, Jonathan Wyatt is the chairman or head of the affiliate committee. They have a brunch and learn tomorrow that hopefully you guys will be able to capture. Kathy Liu and Marcella Ike are two of our purchase specialists that are able to get things done and clear and kind of do the impossible for us. And then also the easiest way to find us is to go to or call any bank branch. There isn't a teller, banker, branch manager that doesn't care about and wants your business. They can route you to our mortgage bankers, and it's very simple to just Google your local branch and give them a call and ask if you need to find us. So we want your business. We have great niches and can help you close more transactions. And with that, let me go ahead and start to introduce my friend Scott Anderson. Scott Anderson is the chief economist and executive vice president of Bank of the West, BNP Paribas. He serves on the bank executive leadership team. In this role, he analyzes and forecasts international, national, and regional economic trends for Bank of the West management, business lines, and clients. Scott Anderson, throughout his career, has been consistently recognized as one of the top economic forecasters in the country. He was named the most accurate forecaster by the National Association of Business Economics for 2019, and he is just a plain great guy. So Scott, thank you so much for joining.
Thanks for having me, John, and thanks to the Santa Clara Association of Realtors for having me today. It's really unprecedented times. There's lots to talk about and discuss. I'm going to start with kind of a broad economic overview, kind of starting with the U.S. economy and what we see happening there, what that means for consumer spending and the national housing market, what that means for interest rates and inflation. And then talk and bring it down to the Silicon Valley level and Santa Clara County level, and really show what's happening in your region and what we think may happen as we look over the next year or two in terms of economic activity. As was alluded to earlier, the economic outlook hasn't looked this bright in a number of decades. I think this year the U.S. economy will probably see its strongest economic growth since 1984. The next 2 or 3 years look to be very strong coming out of this pandemic. We're looking at something very similar to what we saw in the late 1990s in terms of US economic growth. And as you know, the housing market right now is on fire. There's a lack of inventory, multiple bids being happening. And in many ways right now, the market's hotter than even it was during the housing bubble years of 2004, 2005, and 2006. So let's dive into it. I'm happy to answer questions along the way, or we can wait till the end, and I'll be happy to answer any questions that you might have. But first, let's just start with the broad, overview on where we are. Last year was one of the worst economic performances for the U.S. economy, really since the Great Depression. It only lasted 2 months with, basically the shutdown of the U.S. economy in March and April, and then a pretty rapid reopening starting in May. The pandemic is the biggest factor weighing on economic growth. That's hit tremendously hard. Leisure and hospitality, small businesses have been hit extremely hard. But given the COVID relief we've seen from Washington, and right now we're still digesting economically about $2.8 trillion in pandemic relief spending from the federal government. That helped for us to see one of the strongest recoveries we've seen in, like I said, in decades in terms of consumer demand. There's still a lot of imbalances going on right now. We're still not back to full employment. That's going to take quite a few more quarters yet. Even though we expect strong growth in jobs going forward, it's still a work in progress. But the good news here is that's going to keep the Fed fully engaged in terms of monetary support, which means mortgage rates will likely remain quite low. So as we look at 2021, we think we're going to see something around 6.5% U.S. GDP growth this year. On a typical year, U.S. growth is somewhere in the range of about 1.8 or 2%. So we're looking at growth, 3x or more than what we normally see in terms of economic activity. Now that's of course coming from a pretty deep downturn last year, but it's a welcome relief, and we're really seeing a number of things going on. We're seeing, like I said, strong job creation, the pandemic spending, $2.8 trillion. We're also seeing, the U.S. population becoming more fully vaccinated, and there's a tremendous amount of pent-up demand. We don't have a lot of pandemic experiences in this country to really compare economically. The last big one was a Spanish flu in 1918, which we also saw a pretty strong recovery coming out of that. Helped set up the Roaring '20s, for example. But where something similar to that is going on today. And so it's not going to be like coming out of the 2008 2009 recession, where we had a very slow jobless recovery that took almost a decade to get back to full employment. We're looking at something more in the 1 to 2 year time frame before we're going to see a return to full employment. There's a lot of uncertainty, though, globally. There's a lot of parts of the world, like Brazil, India now, with a resurgence of COVID cases, where you're seeing economic growth forecasts slash. But at this point, we don't think it'll be a huge impediment to our U.S. And Santa Clara's economic outlook. We're seeing already in the survey data very, very strong activity as we kick off the second quarter. All these surveys are anything above 50 on these ISM manufacturing and non-manufacturing surveys suggests we're seeing expansion in both manufacturing and services. Anything above 60 is very, very strong. In fact, on the manufacturing side, we haven't seen numbers this strong since 2008. And on non-manufacturing, we've never seen data this strong coming from service businesses. So a lot of this is just the reopening of the economy, and a lot of these service businesses that have shut down are seeing a pretty strong recovery in sales and demand. If you go to the next slide, that's got some people worried about overheating, and I'll talk a little bit about that in a moment. But all that growth does come at a cost, and we are seeing more and more evidence as the data comes in. We got consumer prices and producer price inflation numbers this week for April. They came in a lot stronger than economists had forecast, again, raising concerns about overheating and inflation picking up here as demand just surges. We do see that happening. There are supply chain disruptions as well, and you're really seeing that on the manufacturing side. A majority of manufacturers today, over 50%, are talking about some form of supply chain disruption at the current pace. So you've probably heard in the news about semiconductor manufacturing, how there's a shortage of semiconductor chips. That's affecting production, things like auto, but it's really a broader cross-section of goods than that. It's almost anything that takes a computer chip at this point. They're seeing some production shortages, and it's well beyond just computer chips. We're seeing, shortages in things like lumber and even certain foodstuffs. So it's a broader based phenomenon. It's going to take some time for those supply chain disruptions to ease. During the pandemic, a lot of people stopped ordering, and producers just started planning for a period of really weak demand. That never materialized. In fact, demand accelerated throughout the pandemic, and that's left us with this big gap between demand and supply. It's going to take some time to work that off. Inventories are extremely low as well, and that's allowing a lot of these producers and retailers to push up prices for their consumers. And so we are seeing that, and temporarily we're going to see a period of rapid inflation. I'll talk a little bit about that, but I don't think that's going to be sustainable. In terms of the job market, it's been pretty volatile month to month. In the first quarter, we trended at about 500,000 jobs a month nationally being created. We had almost 1 million jobs created in March. But then we saw a pretty big, disappointing April jobs number, came in at only 266,000 for the U.S. Though you will note that leisure and hospitality here on this chart, we actually saw a really solid 331,000 jobs created. So it's a little bit of a mixed picture month to month. I think some of this may have been, we had a surge in March, I think, as California reopened, and then we gave some of that back, I think, in April. I'm not too concerned about this 1 month of weakness. We're still forecasting about 556,000 jobs a month in the second quarter. And all the other data that we use to try to forecast the labor market actually look very, very strong. Job openings, for example, hit 8.1 million last month. That's the highest number of job openings ever in the United States. So there's a lot of demand for employees. We just haven't seen a pickup in hiring yet. And as you know, a lot of employers are complaining they can't hire enough workers for the available open positions. There's a solution for that. The solution is higher wages that will attract more people into the labor force. But that's going to take some time to evolve. The labor market will rebalance. Some of this is being blamed, of course, on the generous amount of unemployment benefits. I think there's a little bit of truth to that. statement. But again, the one way to get out of that is to see a broader recovery in wages that will bring more folks into the workforce. And that'll be good for the housing market and demand in housing. So we're still down about 8.2 million jobs from pre-pandemic levels as of April. That's not too much better than where we were at the depths of the Great Recession. So that's what Jerome Powell, the chairman of the Federal Reserve, is talking about when he's saying we've got more work to do to bring the economy fully back on employment. The good news is, given our current forecast, we think we'll be very close to full employment at the end of next year or early in 2023. So that's kind of the path we're on. We've got another probably 6 quarters or so of recovery needed in the labor market before we get back to where we were pre-pandemic on jobs. So that's going to lag the overall economy and certainly going to lag overall consumer spending. So this is what our forecasts look like for the unemployment rate. We're at 6.1% right now in the U.S. unemployment rate. That is a strong improvement from where we were in the second quarter of last year at 13.1%, which was the highest unemployment rate in the U.S. since the Great Depression. But we are expecting we'll be back down to around 4% unemployment, which is very close to pre-pandemic levels by the fourth quarter of next year. A lot of uncertainty though, and there'll still be a lot of volatility month to month. So why the positive outlook? Well, we've never seen so much fiscal and monetary stimulus coming from Washington in any post-war U.S. recession. What's been spent in terms of government spending in this pandemic relief since the pandemic began last year dwarfs anything we saw in the Great Recession period. We just we're spending another 2.8 trillion since January, and that spending is going to last, coming from the federal government, probably well into next year. So that's what's really driving the growth we're seeing in consumer confidence and consumer spending. We've never seen income growth of these magnitudes in the United States. For example, this is real personal disposable income per capita. So it's per person in the United States. On average, each person in the United States has seen almost a 30% increase in their real spending after taxes. That's a huge jump. Usually tend to see income growth dropping in recessions or stagnating. We're not seeing that this time around, given the government support. In fact, savings rates have swelled. The personal savings rate in the United States now 21%. If you go to the next slide, because a lot of businesses have been closed, even though spending has been very strong in things like autos and RV and marine, we're seeing a lot of people buying boats and recreational vehicles as well as cars. In some of those big durable spending categories, including housing. But we're also seeing a lot of people being able to save a lot given the income. And so the savings rates, like I said, are about 21% right now in the first quarter. And we estimate that there's an excess savings in the United States of around $2 trillion since the pandemic began. So it's these different surges of paychecks to individuals, the unemployment benefits, the tax breaks that have occurred are all leading to a big war chest of spending power for consumers. So consumers are going to go out there and start spending it. On top of that, if you're lucky enough to own a home, especially a home in California, or you have a stock portfolio and you've been along the equity markets, you're seeing a tremendous windfall in terms of your household wealth. And there's been a lot of attention about the billionaires that have, seen their wealth go up by over, 1.5 trillion in this pandemic. But it's been broad-based, and we're seeing very strong wealth creation across a number of areas of the country, not just on the coasts. And so we think this is another important support for consumer spending. This data comes from the Federal Reserve. It's the overall amount of net worth. So it's total assets, including housing and equities and in bonds that households own, subtracting out any debt they may have. And we've seen that net worth explode by about $70 trillion since the end of the last recession, the Great Recession. That's an increase of 120%. It took us 60 years to increase our wealth that much in this country prior to that. So it's a tremendous amount of wealth here that's been created. In fact, I actually fitted an exponential curve to this data, which scares me a little bit. I actually did my dissertation on financial bubbles and crashes, and some of the stuff we're seeing now anecdotally, you know, the amount of risk taking place, and a lot of, you know, I'd say some risky areas of the market, things like Bitcoin and NFTs, and in some cases real estate. We're definitely seeing this reaching for yield, reaching for return, which isn't a bad thing when the markets are going up, but if financial conditions tighten or we get some other sort of shock in the system, that could set us up for some major financial instability. So that's one thing that we're watching as a downside risk here. But the outlook overall, the baseline view is the consumer is in very, very strong shape. Real consumer spending grew at over a 10% pace in the first quarter. When we got, a lot of people got paychecks from the government in March. We think a very strong growth picture will develop again this quarter. We're looking for 7.5% growth. All this is well above anything we saw in the past expansion. You can see we were trending at 1.5 to, you know, maybe at the best 3.7% of consumer spending in the prior expansion. So, you know, these are really growth rates we haven't seen in the US since the 1980s. And that growth will sustain. And we think that, you know, the consumer will remain strong into 2022, though the overall timing of that will be, we'll see a little bit of a slowdown in spending as we move into 2022 as some of the fiscal stimulus that we got this year begins to fade. But it's a very, very strong picture. And that's why you hear a lot of the talking heads on CNBC and Bloomberg talking about overheating, because, you know, if you add up all the aggregate spending in the US economy, you know, consumers, business investment, government spending, net exports, we're looking at an environment where we will reach pre-pandemic levels of spending this quarter. By the third quarter, our estimate is that GDP will be above potential growth in the US. And you can see that green line, that's our forecast on GDP going forward through 2026. And the blue line is what the Congressional Budget Office assumes is the US potential growth rate. So anytime that green line gets well above the blue line, what that means is there's going to be increasing pressure because of declining unemployment. You're going to see increasing pressure on wage and consumer price inflation. And so this is what we're looking at as we look out over the next 2 or 3 years. Are we going to see a more sustained pickup in inflation, or is it just going to be a transitory increase? Some of the data we're seeing now suggests more of a sustained increase in inflation if these growth forecasts materialize. In terms of the annualized picture on GDP, you can see that we're probably going to peak in terms of GDP growth this quarter. We think it's going to come in at close to 9% growth on an annualized basis, and then we'll start to slow down to around 3% by the second half of next year. Again, still a very, very strong economic backdrop, which would keep the housing market recovery on track, despite, you know, affordability becoming more a factor, I think, as we move into 2022. If you go to the next slide, this is how it looks on a fourth quarter basis. Again, 2021 is the big rebound year in terms of spending and growth, and then we start to see it start to slow down to more normal levels by 2023 and 2024. Again, we don't see any sort of recession, any sort of environment shaping up anytime soon, because the consumer is actually going to be able to spend here for a number of quarters at a pretty very rapid clip, actually. Go to the next slide. What does that mean for the housing market? Well, you've already seen some extremely strong housing data. You know, home builder confidence took off earlier this year. It has moved back a little bit from the recent peaks. Some of that due to the increase we saw in mortgage rates and interest rates and the steepening of the yield curve. But the latest data suggests we're still very, very strong on a historical basis in terms of home builder confidence. And you can see the Western US is even stronger than anything we're seeing nationally. And so again, that shapes up pretty well with our forecasts around housing here for California and the Bay Area. So what's driving that? You've probably heard a lot, record low mortgage rates certainly help. The fact that, consumer household balance sheets are flush and pristine. That's an incredibly good backdrop for the housing market. On top of that, you've had the working from home phenomenon, which driven a lot of people out of the cities into bigger houses in the suburbs. I think that trend will slow a little bit, but it's still, I think, in place. Most big employers that we talk to, they're looking at some sort of hybrid or flexible working environment where, at least some days of the week, people are still going to be working from home if you've got one of these office jobs in the city. And so that's going to be good, for the demand we're seeing in the suburbs and some of the outlying areas to continue. I think the other thing we're seeing is millennial demand. Just a tremendous amount. Millennials now are the biggest demographic in the U.S. They're bigger than baby boomers in terms of the labor force, and their presence is being felt now across the board, especially in the housing market, as they get to the point in their careers and their life where they're actually looking to buy houses. And so we have seen in recent years a pickup in household formation and housing demand from millennials. They have a long way to go to catch up with previous generations, including Gen X. And so you're seeing that pick up. And the good news is they're saying in the surveys that they're still very much believe homeownership is an important part for personal success. So I don't see evidence that they're turning away from the traditional housing markets like you've heard some people say in recent years. So I think that's a good sign for overall demand. And how tight are the inventories? It's really remarkable. If you told me that, we were going to see unemployment rates in double digits for much of 2020, and we'd see this acceleration in the housing market, I don't think anybody would have predicted that, including ourselves. We didn't really, when this early in the pandemic, we didn't see this, though we do recognize the phenomenon, and we now agree that any sort of slowdown we see in the housing market in 2022 is going to be pretty gradual at this point, given the pent-up demand. So, a couple of things on existing inventories. We only have about 1 million houses on the market right now, the existing housing market as of March. That's quite near expansion lows. If you go to the next slide, you'll see. So one of the things we're noting is that the strength, not like during the bubble years in 2004, 5, and 6, when housing demand was and home price growth was really, really concentrated in the coast, in particular California. This time around, we're seeing broad-based demand across the country, including some of those rural areas and Midwest areas that really missed out last time in terms of the housing recovery. So that's a good sign that we're seeing very broad-based home price growth, that this could be sustained for some time. It's not a bubble. Month supply is still around 2 months of existing single-family homes. Even in 2005, kind of during the bubble years, we were still at about 4 months of inventory. So, like I said, we're probably seeing some of the hottest housing markets of our generation and of our lifetime right now. And of course, this is impacting existing home prices as well. These come from the various Case-Shiller home price indexes for the United States. Did want to show you this because comparing to where we were in the bubble years, from 2004 to 2006, we're now seeing prices accelerating at a pace we've never even seen before. Not only are home prices higher than they were at the Great Recession peaks, as this acceleration in home prices has really been unprecedented. If you go to the next slide, and probably not sustainable. You can see that late last year, home prices were rising at over a 20% annualized pace in the United States for purchase-only housing. That exceeds anything we saw during the pre-Great Recession period in the housing bubble years, and shows the broad-based nature of the home price gains we're seeing. We are slowing down from that pace, and that's in line with our forecast, but we're still at double digits nationally on an annualized basis. And we expect that slowdown will continue as affordability becomes a bigger issue in some of these higher priced markets. Also, as interest rates start to rise, which we do think they'll continue to do, mortgage rates will follow. And so we'll have a combination of those factors playing out. But I don't see any sort of crash in home values or crash in home sales here, given the strong underlying fundamentals for the economy like we saw in the post-bubble years in the Great Recession period. So one thing we are watching very closely is the rate environment and what the Federal Reserve is going to do given the strong growth outlook. And what we're all seeing is higher inflation pressures and higher inflation for consumers. We've already seen a significant tightening or steepening of the yield curve. For the mortgage market, it's the 10-year Treasury yields that matter the most. And so, if you look at the 10-year maturity on this curve, you can see that the 10-year Treasury yield last year at this time was around 0.64% in nominal terms. Today, we're trending at just over, I think, 1.65%. So we've had, about 100 basis points or 1 percentage point increase in the 10-year, and that has translated into higher mortgage rates as well. But not enough, as you can tell, to really stifle demand. So what that tells me is the market can handle an even steeper yield curve without, really causing a huge problem for this expansion. And that's exactly what we're forecasting. But what the big debate you're going to be hearing about in the next several months is really on the inflation side. Will this growth? There's pretty broad agreement among economists. We're in a very, very strong growth environment. Housing market's going to remain strong. The question is, what's the downside here? Are we going to see more inflation? Will that cause the Federal Reserve to raise interest rates sooner rather than later, which could push up mortgage rates and be a bigger problem for the housing recovery? At this point, we still are in the transitory camp in terms of the inflation pressures, though I will admit the pressures we saw in April from the recent data that was released this week were stronger than we expected. So that means inflation is going to be running a little bit hotter than we thought, at least probably for the rest of this year. But as we move into 2022, I do think those inflation pressures will start to continue to ease. And by 2023, we should be back down to the Fed's 2% inflation targets. But right now, we're going to feel the squeeze a little bit. Gasoline prices with the pipeline shutdown, adding to some of those pressures on the East Coast in terms of gasoline prices, really showing up in the commodities market. Overall commodity indexes are up about 50% from where they were a year ago, but you can see certain categories. I don't have lumber on here, but lumber is up 253% from a year ago. But you can see strong gains in things like gasoline, corn, crude oil as well. So it's a broad cross-section of commodities where you're seeing that demand. And we're also starting to see consumers factoring this in as well. We really haven't seen a lot of inflation fears, but at least consumers now are starting to see rapid inflation, at least over the coming year, in things like gasoline, rents, and medical care. Obviously, these are big spending categories for consumers. And right now they're predicting 9% plus inflation in those categories. There's other categories where we're expecting lower inflation, things like college education. But even there, in those categories, we're looking at consumers expecting 6% inflation. I don't think inflation is obviously going to get that high. These surveys always tend to have higher inflation overall than what we see in the CPI or PCE indexes of consumer prices. But it is something that we're watching quite closely, and the Fed's watching quite closely to try to calibrate when they should start tapering their asset purchase and really think about raising short-term interest rates, which will almost immediately have an impact on mortgage rates. Let's go to the next slide. We're also seeing the bond market already pricing in some inflation here. If you look at inflation break-evens in the bond market and the 2 and the 5-year and 10-year timeframes, we're seeing some of the strongest now inflation being priced into bonds at the current interest rate in 15 years. So, I think a lot of this inflation that we're seeing is already kind of priced into the yield curve. So I think we're in a bit of a range here. in terms of bond yields and mortgage rates. I don't expect a big surge in mortgage rates anytime soon, but we are watching this, and this could be something, if it continues to rise, the Fed might actually start to respond to, though I think we're still a couple years away from a strong response from the Fed. So looking at the inflation spike, given the data we got this week, we are raising our forecast for second quarter CPI inflation. We were forecasting a spike to 3.2. We're now predicting a spike to 4.2. So we are coming in pretty hot here on inflation, though we do notice that we have this downward trend in inflation from here. So some of this is due to base effects. We had really low prices when the economy shut down in the second quarter last year. So that's what's artificially driving up these inflation numbers. But then as we move longer into 2021 and into 2022, we think that inflation rate will move back down to around 2%. So it is, by the Fed's definition, more of a transitory spike in inflation due to supply chain disruptions and some of the other pent-up demand that we're seeing in some of these categories. You know, one of the biggest categories for spending and where price increases last month was used cars. And so it's people, you know, actually going back and spending in areas they haven't been spending. We're also seeing a lot of price inflation right now in transportation as airlines start to raise their airfares from you know, pandemic levels. So that's going to continue to put some upward pressure on inflation this year, but as we move into next year, it'll be less of a factor. So the bottom line here, rising rates is certainly baked into our forecast as we look out over the next 2 or 3 years. And eventually the Fed will start to raise rates too, which will add to some of that upward pressure on long-term mortgage rates. But for the coming 6 quarters, we think that pressure is going to be relatively small. Like I said, a lot of this inflation we're seeing is already kind of priced into mortgage rates and the yield curve. So we're only expecting a gradual increase in the 10-year. And one thing you'll notice is we don't expect the Fed to respond very aggressively to this inflation. As you'll notice, the FOMC has been talking about, you know, this inflation being transitory, that they're going to be very patient and wait until they see actual inflation and unemployment rates getting back to full employment. So in that sort of timeline, our forecast is the Fed's really going to do nothing this year. They're going to really kind of sit on their hands and see how the economic recovery develops. I think as we get into next year, then we will start to see the Fed tapering their asset purchases. Right now, the Fed is still adding to the money supply, buying about $120 billion in treasuries and mortgage-backed securities a month. They're going to continue spending or buying assets at that pace through the end of the year. But as we get into next year, they'll start to taper that back. And that'll happen over about a 6-month period. So by the middle of next year or end of next year, the Fed will probably no longer be expanding their balance sheet. Then they'll probably wait a whole other year, I think, before they actually raise rates. So I think we're looking at something somewhere in early 2024 for the first Fed rate hike. Again, the Fed's really going to be out of the picture here probably for another couple of years. Go to the next slide. Can we advance to the next slide?
For some reason, the system is frozen.
Oh, no.
I'll ask a question then. That
Yeah,
came
sure. Let's get time for a break. Yeah.
and
Go
then
ahead.
go through that. Yeah. Do you predict housing prices to continue to increase here in the Bay Area through 2022, 23?
We do. I do think, though, because of affordability, that, and even in what you probably heard too as well, that, you know, the net migration trends in California have turned more negative during the pandemic. You know, there's been anecdotal evidence of people moving out of state, moving, you know, to Texas or Florida, certainly in the Valley, where, you know, working from home is a pretty strong option for many tech workers. And we did see that in the data. The state of California actually put out some population statistics last week, actually showing the state of California lost population in 2022. It wasn't a big drop, down 0.5%, but but it is something to keep an eye on. We did see similar sort of out-migration from California during the bubble years, and that did eventually lead to a pretty sharp slowdown in the economy and home price growth. But we're not seeing the excesses in terms of lending. Banks have been very cautious in their underwriting standards. So it's not something that we're super concerned about at this point. If we're having trouble with the slides, I can maybe just talk to some of them.
I believe I have the slides, so let me pull those up. And somebody asked the question if you can have the slides, and yes, I will be showing. I will be able to share the slides with everyone, and we will get this recording up so that you can review it. I do see someone has their hand raised, but if you could put your question in the Q&A, and then we will get to it. And I'm just downloading. What were we on? Slide 27, I believe.
We're just going to turn to the Silicon Valley's economy and housing outlook. So,
perfect.
Yeah,
and I'm gonna.
29.
You start talking. I'm gonna get to the slide she was just on.
Sure. So I'll start. So the question is whether Silicon Valley's economic future remains bright or not, and my answer is absolutely yes. And as you know, California has struggled throughout this pandemic. The state of California has been in shutdown mode a lot longer than a lot of other states have been. So we've actually been lagging the nation in terms of job recreation. It was just a month or two ago that the state of California actually reopened the economy, and we are starting to see a surge in jobs here in Silicon Valley as well as in California. Oh, thank you. Yeah, we're up and running now. Again, if you go to the next slide, I'll talk a little bit about what we're seeing in terms of venture capital money flowing into the region. There's been a lot of people saying, well, maybe Silicon Valley will not get back to its former glory. We've seen a lot of jobs move to the state of Texas. Tesla moved down, was a big one that moved to Texas, moved their headquarters down there. But we're still not seeing any sort of shortage in terms of venture capital money flowing into California. And a lot of that, of course, is coming into Silicon Valley. First quarter 2020 we saw a very strong jump in venture capital money, up about 86% from year-ago levels. Deals also went up as well. So it's a very strong growth number. Second best actually that we've seen going out all the way out, including the dot-com bubble years of 2001 and 2001. So again, California and Silicon Valley is still very much a growth driver for the state of California and for the country as a whole. If you go to the next slide. Where'd that money go? Well, it's going into mobile and telecom. So we're seeing really strong, at least in the first quarter, real strong venture money moving into those sectors. Healthcare has been another important sector of growth, as well as software. We're actually up 112% in terms of venture capital funding since the fourth quarter of last year. So again, a good sign here that the money's flowing. Financial conditions are loose. The state of California recently, they just revised up their budget surplus for the state of California because stock prices have been so high. There's a lot of money, stock money being made, stock options being made here in the valley, and that's going to continue to pump up and keep home prices elevated. Go to the next slide. On the labor picture, like I said, California has been kind of laying the recovery we're seeing in jobs nationally, but I do think California will start to catch up. It might take most of this year, but as we get into 2022, we do think California's job growth will be on par, if not better, than what we're going to see nationally. And I certainly see in the Valley stronger job growth than we're going to see nationally next year. Right now, for the Valley, we're predicting about 2% job growth this year and 4% job growth next year. These are pretty strong numbers and even better than what we're going to see in the entire Bay Area. than we think we'll see in the entire Bay Area or the state of California over the next couple of years. And so that's an important support for the housing market. Next slide. In terms of the job loss, where the jobs have been lost, it's the usual suspects: leisure and hospitalities. Jobs are down about 40,000. Education, healthcare, government have been big, areas where we've seen job loss. But information, which again is tech, we've actually seen a creation of 800 jobs throughout the pandemic. So again, that's the strongest sector, and really the only sector in the Bay Area where we've seen job growth over the past year. If you go to the next slide, here it is on a percentage basis. So like I said, we're not back to full employment yet by any means, and I think for California it's going to be at least the end of next year, if not into 2023, before we get there. But leisure and hospitality is the area that we're going to see some of the biggest job gains, I think, because we're still down about 38% from where we were a year ago. Go to the next slide. In terms of the unemployment rate, it has come down quite strongly. Silicon Valley's unemployment rate peaked at about 13.1% this time around, which even exceeded, what we saw during the Great Recession period, or even the dot-com bubble years. But already we've moved back down, at least through February, to 5.5% in the Valley, and our forecast is we'll probably trend at around 4.9 this year, and move even lower next year. So we'll be back to full employment, at least in terms of this measure, probably by the end of the year, if not early next year. Let's see, one forward. Yeah, in terms of incomes, there's no sign of trouble here. Personal income growth, in nominal terms, still growing at upper single digits, not roaring growth by any means. This is only through the fourth quarter, though, of 2020, so we really aren't picking up yet the paychecks that went out to individuals from the coronavirus relief bills. But again, there's again another sign that the economy is on a very solid foundation here and will continue to drive the housing recovery. If you go to the next slide. Okay, this gets back to what I was talking about earlier about population growth declining in the state of California. San Jose, the population actually dropped a little bit more than the state. It was down 1.1% in San Jose. Though there are parts of Santa Clara County, even though Santa Clara County overall lost jobs, lost population about 0.6%. Santa Clara City Metro actually gained jobs. And we're seeing also continued job growth in places like Mountain View, Morgan Hill, are areas where people are still moving into in the Santa Clara County area. But we are definitely seeing a kind of weakening of population gains, and that's showing up as a decline in labor force as well. So there is evidence here that people did move out of the state or move to other parts of the Bay Area, more affordable parts of the Bay Area. One area that's been strong in the Bay Area in terms of population growth and housing has been the Oakland area, Alameda County, and Contra Costa County. We've seen some really strong in-migration population growth. If you go to the next slide, that's the more affordable area of the Bay Area. If we look at Santa Clara home sales, again, this is coming from CAR itself, but I'm sure you're pretty much aware of this data, but we're seeing very strong existing single-family home sales growth in Santa Clara, up 44%. Not the fastest, and so we're seeing some of the fastest rebound in places like San Francisco and Napa, but and like I said, Alameda here, you're seeing a strong rebound as well. But again, much stronger than what we're seeing for the state as a whole. Next slide. Again, inventories in Santa Clara are extremely tight. I showed nationally it's about 2 months of inventory, but here in Santa Clara, it's about 1.7 months of inventory. So again, this will keep prices elevated and again, limit any sort of downside in terms of home price growth. If you go to the next slide. Valuations, housing's certainly not cheap in the Bay Area. Everybody knows that. In Santa Clara, I think we reached new record high levels last month in terms of median sales prices, about 1.6 million median price in Santa Clara. Not the most expensive area in the Bay Area, but pretty darn close to it, and more than double the state level average. So that is going to have some impact, I think, on our forecast as we go forward here. If we go to the next slide, we are already seeing, at least on a month-to-month basis, Santa Clara's home price growth has lagged a little bit, well, the state level average. You can see some of the strongest gains last month were actually coming from Contra Costa County, where, like I said, housing's a little bit cheaper. So we are seeing some evidence here that, you know, high prices are having some limiting factor on further home price gains. You can see San Francisco has been one of the weakest areas on that slide. Go to the next chart. And so, yeah, so for Santa Clara, we're actually seeing home prices rising at more closer to the US average than, you know, what we're seeing in the California average. California's home prices, a median basis, are probably rising at twice the pace of the national average, and, you know, even faster in Contra Costa County, you'll see. But some of those more expensive areas, particularly city of San Francisco, where you've seen quite a bit of out migration and population loss. San Francisco, the city of San Francisco actually lost population of about 1.7% over the past year. That's where the home price gains have been the weakest. And we're seeing more of the downward pressure on rents in those areas as well. Go to the next slide. In terms of the home building front, we're not worried about, you know, home building surge that's going to really change the dynamics in the existing housing market. Like I said, more of this is kind of going to be a death by 1,000 cuts. You know, it's going to be rising prices, going to be rising mortgage rates. Some home building activity will pick up as well to rebalance the market, but there's no real sign here that this isn't a sustainable housing recovery. And again, underwriting standards have been a lot more a lot better than they were in the last time around, and so we do see some sustainability here as we go forward. We're not going to see every month home prices rising at a 20% annualized pace. We do think home prices are going to slow by the end of next year into the low mid to single digits. But again, this is going to be one of the best periods for home price growth we've seen really since the Great Recession, pre-Great Recession period. So home builders are building a little bit more, but they're actually below the 2018 peak here for San Jose, Sunny Valley, and Sunnyvale and Santa Clara. So we're actually not seeing builders going crazy here in terms of supply. So I guess I'll end there. I know we're kind of running out of time, so I'll just open up for any questions you guys might have in the last minute. I'm happy to stay a few minutes longer if you need or want to answer questions you might have.
So I've got 3 questions. And again, if anybody has any questions, please do put those, and I'm going to stop sharing here. And again, these slides, I will send them out to everybody so that you can have a copy. So the questions that we have, the first one would be, how do you project building material costs in the future?
Yeah, so we're seeing a lot of those supply chain disruptions, a lack of supply in building materials, right? Lumber is the big one everyone's been talking about, but it's a broad cross section of building materials where we're seeing that upward pressure. And we've actually seen a surge not only in construction activity nationally, but also remodeling activity, you know, the Home Depots of the world as well. Sales have been extremely strong, one of the stronger categories in terms of retail spend. So that certainly wasn't factored into a lot of you know, building material producers. You know, I talked to some of the window manufacturers, and they actually scaled back on capacity. So they're in the mode of scrambling to try to catch up. We do know that the inventories are extremely tight. So I don't think these price pressures are going to go away anytime soon. I would say though, it's still, you know, a relatively minor factor when people buy a home, especially if they're buying a new home. They're usually willing to pay a little bit of a premium for a newer house. And I think that's one thing we've actually seen throughout this pandemic is people actually are looking to buy newer homes. So, and I guess there's so much liquidity out there that, you know, so it is adding to the price of new. I think the Home Builders Association put out some numbers recently. I think there was somewhere in the $35,000 to $40,000 range that, you know, lumber prices themselves are putting upward pressure on new home prices nationally. But it seems like a lot of money, but actually, if you're still looking at record low mortgage rates, how much does that really push up your monthly payments? Especially when you're looking at a $1.6 million house or more. It's a relatively minor factor, I think, for the overall demand for housing. And so, we don't see anything. And I do think those supply chain disruptions will ease over time. It's probably going to take another couple of quarters or 2 or 3 quarters before things get more into balance, and demand will slow down a bit on the consumer side as well, which will help with that rebalancing. But we're probably in a 2 to 3 quarter period here where we're going to have to see some of that excess buildup of supply to meet current demand.
Okay. Let's see, what is, and I don't think you can say exactly what is, but what do you think is causing the increases of home prices in the Bay Area? Is it only because of lack of inventory and the low interest rates?
Well, no, I don't think so. I think there's a sentiment factor here. I think people, I don't know about you, but a lot of people, when they've been sitting at home over the past year, have been rethinking their life and their lifestyles. And they're realizing that life is pretty precious, and they don't want to, waste the remaining years they may have on this planet. So I do think people are, that's an interesting phenomenon. I think it's driving a lot of these kind of unusual sort of things we're seeing in terms of consumer behavior and what they're buying and what they're not buying. Some of this I think will start to fade as the pandemic kind of gets further in the rearview mirror, but no, I do think housing is one area where people have decided they're willing to put more money in that for a bigger house. Some of that's because of working from home and wanting more space from maybe some of the kids when they're on their Zoom calls. I don't know if you heard my son earlier, but yeah, that happens. So you'll see some of that. But I do think also just the unprecedented amount of income growth we've seen is really unprecedented. I was a bit surprised when the Biden administration expected another or proposed another 1.9 trillion in coronavirus relief spending, because we had just done 900 billion in December with the previous Congress. So I think it was a little bit on the big side, and I think we're seeing some of the downsides from that now because of the acceleration we're seeing in inflation and the overheating in certain areas. I also worry a little bit because I really want the Congress to pass a big infrastructure bill, because I think that's going to drive a lot of construction activity and good jobs for non-office workers, and really help other areas like the rural areas and parts of the country that have really been left out in some of the tech growth we've seen over the past 20 years. So I think it's tremendously important we pass an infrastructure bill. I'm a little concerned now because of the overheating we're seeing and the pickup in prices. There won't be a huge appetite for an infrastructure bill, but I do think that's still a necessary thing if we want to have a sustainable recovery, not just over the next quarter or two, but over the next decade or two.
I have 2 more questions here, and I'm going to ask one of them first before the other one because you just kind of touched on it. And this may be a loaded question, but what would you do to curb inflation?
Yeah, well, I'm not, like I said, I don't think inflation needs to be curbed at the moment, even though we're talking about all these supply chain disruptions. I actually looked at the CPI index yesterday compared to where it was pre-pandemic, and we're up about 3.2% on consumer prices from pre-pandemic levels. So it's not quite as bad as the year-over-year number we saw yesterday at 4.2. Some of that was due to the base effect. So that's probably elevating inflation numbers by more than a percentage point or so now. And the Fed really wants at least a period of time. They don't want inflation to be high forever, but inflation has been too low. In the last expansion, inflation barely ever hit their 2% target. In most years, it was well below that on core inflation. So they actually want a period of rising inflation expectations, rapid growth. And one thing they've realized that they can actually run the economy hot for longer without, being too concerned about, double-digit inflation like we had in the 1970s. So it's a pretty big experiment.
Did we just lose Scott?
Are you still there? Can you hear
Yep,
me?
There we-
okay,
there
there
we
we go.
One way actually to slow inflation, if you need to, is for the Fed to actually start taking away the punch bowl and raising interest rates. That will slow down the economy, economic growth, and inflation. But the Fed's not ready to do that yet.
And the last question that we have in here is how does, I know one more just came in, but how does, and again, if you, we do have Scott for a little bit longer. So how does the labor shortage issue affect hospitality industry, especially the restaurant industry?
Yeah, so you can see the leisure, hospitality, restaurant industries have lost the most in terms of jobs. A lot of those folks are still at home. They're now reopening. Some of them are getting their jobs back. I think some employers, though, have realized they probably don't need as much staff back as they once did. Some of them are using new technologies so that they don't need as much labor. So there is actually an excess supply of labor in those industries. But I also think that in some cases, people don't feel a lot of urgency to go back. Like I said, a lot of households have been able to build up a lot of savings. Maybe they're not anxious to get back to those restaurant and jobs. So it'll be an interesting phenomenon. I know small businesses are saying that they're having trouble hiring these workers, and they're seeing evidence of that in the job openings data. We're seeing evidence of that in survey data from small businesses, where about 43% say that they're having trouble filling open positions. That's some of the highest we saw in the last expansion. So we're definitely seeing those pressures. I think they will ease over time. One thing the president pledged just in the last day or two is that they'll be focusing more on making sure that people that are collecting unemployment benefits actually are looking for work, and if they get a viable job offer, that they actually take it, or they risk losing those unemployment benefits. So I think that might help to some extent as well. But there is evidence that with these higher benefits, that people have been slower to return to the labor force. One solution, obviously, and I talked a little bit about that, is higher wages. And we're seeing some of the evidence of that. Even I think McDonald's said they're going to raise their wages to their employees to an average of $13 an hour. So I think you'll see more evidence of that happening in the months ahead, and that'll help rebalance labor and bring people back into the labor force. Some people have exited the labor force and just don't plan on coming back. Some of the boomers just decided to retire early. The only way to get those folks back in the labor force would be to offer them more incentive to come back to work.
So there's another question, but I thought of a question. And sometimes when you see those wages going up, and it's happened, I think, in the city of San Jose, where you have that cost of living where everybody has to make a certain amount, and the minimum wage in the area goes up, that the cost of goods go up. Do you think that that's you'll see, like you mentioned, McDonald's, the cost of McDonald's going up and things like that, and have that impact?
That's the $800 million question. I think historically, when we've seen wage inflation pick up, that does lead to more sustainable increases in prices. We really haven't had a period like that since the 1970s. Obviously, the economy's structure has changed a lot since then. We have a lot more gig workers, people working from home. And so that link, and the Fed talks about this as well, is that link between wage growth and prices is a lot less tight than it was in the past. So we might even see higher wage growth, but that doesn't necessarily mean we're going to see as much of a sustained increase in prices. I don't think the link has completely disappeared, but it'll be a big test to see, how tight that relationship is going forward. Some of that was due to China, right? With the expansion of China into the global economy, and their labor force was unleashed, that really helped hold down U.S. wages, even as prices and profits went up. We'll see if that's still the case or not, because wages have gone up in China as well. So maybe it won't hold down wages as much as they have in the past. So it's a big change.
And the last question that we have in here is, how do you see the government spending and proposed taxes increases affecting consumer spending and the housing market with possible changes to 1031 exchanges?
Well, I'll just say in general, I'm not familiar with the 1031 exchanges, but one thing I'd note is that these new spending proposals that the president's made on infrastructure and the Families Act, while I do think they can boost U.S. productivity growth longer term, they're not. It's not just a pure stimulus, because the way they're proposed is with tax increases, and they are proposing increases in corporate taxes from 21 to 28%. Though it looks like he's willing to accept something around 25% or something in terms of corporate taxes. There's also going to be an increase. This is going to be important for a lot of your Santa Clara clients and customers. Is a potential impact in terms of increasing taxes, federal taxes on high income households, those making over $400,000 a year, which is almost probably everybody in your zip code. And so that's going to have some impacts. I don't think it's going to be a game changer. In fact, the data that we've seen from past historical studies on tax rates and the economy and spending, it's a very loose relationship. In fact, some studies show almost no relationship between taxes and spending. So I think the economy is going to be strong enough to weather, tax increases without too much downside in terms of economic growth and spending by consumers. And that again is going to be pretty good news for the housing market. That there's nothing on my radar screen that's flashing red right now, suggesting that the housing market's about to take a deep pause or dive.
Awesome, thank you. And I want to thank all of you. If everybody has any closing thoughts before we wrap up for today, John or Emma or Scott, do you have any closing thoughts for us?
No, I'm just hope everyone has a successful and healthy year ahead. I know we're all looking forward to a more normal year for the rest of this year and into next year. So I just wish everyone well, stay safe, and try to enjoy the years we have left on this earth.
Yep. And thank you guys so much. And again, thank you to Bank of